Welcome to the Finance Garage podcast, your go-to podcast for navigating the world of finance. I'm Jonathan, your financial guide, bringing the latest market trends, investment strategies, and financial news that matters to you. And by the way, I'm also going to share my other passion, which is cars.
At the SWU Group, we help everyday families achieve financial success. Our integrated services include financial planning, accounting, credit advisory, and estate planning. We're here to guide and support you every step of the way, from custom investment strategies to maximizing tax efficiency. We ensure your financial goals are met with peace of mind. Visit simonwu.com.au for more information.
Hey everyone, and welcome back to another episode of the Finance Garage. As always, it's Jonathan Wu here, Senior Financial Advisor and Principal at the SWU Group. Now, as you well know on this podcast, and as my role as a financial advisor, superannuation and investments are incredibly important concepts, but the big picture, i.e. the world economy, is actually driven by something else: central banks. These are the organizations that set interest rates and try to keep economies stable. And today, I want to explain what central banks actually do, why they are deliberately kept separate from politicians, and most importantly, as to why I want to talk about it now, is because we've now seen Donald Trump's first full year completed in his second term, and he himself is trying to push to control the US Federal Reserve. And that puts the US Federal Reserve in real danger. Because we've seen this happen in the past, and history has taught us that it is a bad idea because it creates other risks. And we'll also go through why independence, in of itself, for central banks is one of the most valuable assets a democratic country has, including Australia. Now, if we kick things off, let's talk about what is a central bank. The basics of it is that a central bank is like a referee in the financial system. Its main job is to control inflation, which means keeping prices stable, and to support jobs and growth. Okay? The way that they do it, being the main tool that they have at their disposal, is interest rates. If inflation is high, they lift rates to slow spending and discourage you spending the money to put it into the bank, where you're deriving higher interest rate through savings accounts and term deposits. But if vice versa, if the economy is weak, they cut rates to encourage borrowing and investment. So if we look at that sort of immediate post-COVID era where we saw the RBA increase rates in Australia 13 times straight, that was because inflation was running too high. And if we let inflation run too high for too long, that creates a whole raft of other issues, and it opens up a can of worms that's very hard to put back in the can. Now, the other roles that most people haven't heard of, which the central bank serves, is that they can settle payments with each other, they provide emergency cash in a crisis, and they keep confidence in the financial system. Now, if we get to the topic of today, why independence matters for central banks is that if politicians could control interest rates, they'd almost always want them low, especially before an election, because if you reduce rates prior to an election, growth is strong. You go out to the public and say, oh, I've maintained a really strong economy, interest rates are low, everyone's happy, everyone's feeling growth, then you're more likely to get re-elected. Now, that might feel good in the short term, but it risks higher inflation and bigger problems down the track. If I sort of allude to it as an example, right, in real world terms, now if you imagine a football team, you could tell the referee when to blow the whistle, you'd quickly lose trust in the game. Same thing if governments could set interest rates. It becomes about politics and not stability. Now, a key moment in history that we need to look at, which established the central bank independence from the government, happened in 1951. And this was called the 1951 Accord. Because during World War II, the Fed in the US was forced to keep interest rates very low to help the government borrow cheaply to fund the war. But then straight after the war, undoubtedly inflation went crazy, similar to what we saw post-COVID. So the fix was in 1951, the US government and the Fed signed what's called the Treasury Federal Reserve Accord. And this agreement gave the Fed back its independence to set rates without being told what to do by politicians. The reason why it matters is because this was a turning point. It was the first time we saw laws being passed to separate the government administration authority versus the interest rate authority. It proved that letting the central bank act independently of the government keeps inflation under control and gives investors confidence. So in 1951, that was the year that the Fed got its freedom papers. It stopped being a servant to the Treasury Department and started being the referee again. But then came the 1970s, where we saw political interference create the risks that we were trying to hopefully avoid today. In the early 1970s, President Richard Nixon wanted to get re-elected. As I suggested earlier, how do you get elected or re-elected? In this case, keep interest rates low. So he leaned hard on the Fed chair at the time, Arthur Burns, to keep the rates low. The short-term result was simple. The economy boomed, and just in time for Nixon's re-election, which is great, he got re-elected. But the long-term cost was inflation soared, and the US actually spent the next decade battling high prices, high wages, and eventually much higher interest rates to clean up the mess. What was learned, hopefully, or at least at the time, was that political meddling feels good at first, but often leaves us with much bigger problems. If I draw a parallel, it's pretty much like eating sugar all day. You'll feel great for a while and then boom, you'll crash, or at worst, your teeth fall out. Nixon's push for low rates led straight into one of the worst inflation decades in US history.
Ready to take the first step in investing, or just looking to continue growing your wealth without being inundated with financial information? With SWU Online Invest, we offer a range of expertly managed portfolios designed to match your investment needs. Whether you're a seasoned investor or just getting started, know that we will work tirelessly to ensure your investments are strategically positioned to maximize your goals. Visit swuonlineinvest.com.au today.
Now, another reason why independence is so important is because it keeps costs low. When investors believe a central bank will fight inflation, try to encourage growth and employment, then they're happy to lend money to the government at lower rates. They trust that their money won't be inflated away. If trusts break, and if the people think the politicians are running the show, investors demand higher interest rates to compensate for the risk of inflation. You think about anything in the world, why are there investment opportunities that offer a higher rate of return? Not because that there's a free lunch, but there is some risk, whether that be liquidity risk, volatility risk, capital loss risk. All of these are naturally compensated in the world with generally higher rates of return for you to bear those risks. So if the government is riskier, then the government trying to borrow money to fund their expenses also are higher, which then feeds into higher mortgage rates for you and me buying houses, which leads to higher business loans in terms of interest and less affordable credit for households. So in a very ironic way, if you think about it, politicians that are pushing for cheap money now can make money actually more expensive for everyone later on. So if we then look at what Trump is threatening now, is that, well, reports say that Trump and his advisors want to bring the Fed under much tighter White House control. Now that could include putting loyalists in key roles or changing the rules so the president can push for rate cuts. Now this is similar to what we see for those of you that follow the sort of legal side of things in the US. You've got the Supreme Court, which is made up of X number of judges. And if a judge decides to retire or passes away, the incumbent president has effectively the choice as to who he then appoints to the Supreme Court. Now, the net result of that is that you can stack the court, or what's called stacking, either for the Republican side of politics or the Democratic side of politics. And so in the same way, Trump could potentially put loyalists in key governor roles. And we know that Jerome Powell is not getting extension to his contract. And Trump has made that unequivocally clear. The two of them clearly don't get along. And if you think about the motive as to why Trump wants to control the central bank, it's what I've said a couple of times already. It's the cheaper borrowing cost. It would keep the economy running hot while it's in power and markets high, which is great for an election campaign, noting that by the end of this calendar year, he's going to face midterms, and in 3 years' time, or 2.5, when the campaign starts all over again, they'll be fighting for another election. Yet, we also have to remember, Donald Trump technically can't go for a third term because this is already his second term, even though it's not 2 consecutive ones. Now, the danger for all of this, if Trump takes control, is that if investors see the Fed as no longer independent, they'll stop trusting the US dollar. Yeah, and that's going to be a problem because bond yields would rise, confidence in the US as a safe haven would fall, and borrowing costs would broadly go up, not down. The global impact would then be huge because the US dollar is ultimately the world's reserve currency, meaning it's the highest level of liquidity you can always get, and people trust in it. Not necessarily trusting in the US economy, it's trusting the US dollar and its ability to be able to give you the opportunity to exchange for goods and services. And if the trust in the Fed slips, it affects every global market, including Australia, right? If Trump forces the Fed to do his bidding, it's like the captain telling the umpire when to blow the whistle, and it might help him win the game now, but it destroys the credibility of the sport. So if we sum up these risks, we remember that independent central banks equals stable prices, lower borrowing costs over time, and political interference means short-term gain, long-term pain, with higher inflation, higher interest rates, and weaker confidence. And as I've already noted, history proves it. The 1951 Accord fixed it, Nixon broke it, and we still talk about that inflation decade now. It's not like, we don't know if we put 1 and 1 together, it's going to make 2. And if Trump goes and controls and artificially decreases interest rates, we will face inevitably the same problem. And right now, the risk isn't all that theoretical. Trump's been pretty open about his plans to pressure the Fed, which shows, how fragile independence could be. So remember that central banks, even though they're independent in democratic countries, they aren't perfect. And they are one of the few guardrails we have in the global economy. Independence is the shield that keeps inflation expectations anchored and borrowing affordable. If that shield gets broken, every household and business actually ends up paying the price. So the next time you hear a politician demanding lower rates, remember the sugar hit. Feels good now, but buddy, the bill always comes later. Hope you enjoyed today's episode. As always, if you have any feedback or interested in learning more about other topics, feel free to hit me up on all the socials. And as always, remember that this podcast is for entertainment purposes only. Listen to the disclaimer at the end. Until next time, tune into the next episode of The Finance Garage. See ya.
This podcast is not financial product advice and is intended to provide information only. It does not take into account the investment objectives, financial situation, or needs of any person. You should assess whether the information is appropriate for you and consider talking to a financial advisor before making any investment decisions. Any investment examples are for illustrative purposes only. The information is taken from sources which are believed to be accurate, but Simon Wu, Jonathan Wu, SWU Financial Planning, and Personal Financial Services Limited accept no liability of any kind to any person who relies on the information contained in the podcast. Unless expressly stated, none of the information should be taken as a recommendation. For more information, please visit www.simonwu.com.au.